Markets are sending mixed signals today, and most investors are reading them wrong. Let's look at what global markets are actually doing right now. In Asia, market behavior remains mixed. Some equity indexes are attempting to stabilize after recent sell-offs driven by trade and tariff concerns. At the same time, key regional currencies remain under pressure. That tells us one thing: stability is tentative, not confirmed. In Europe, markets are trading cautiously. Investors are reacting to macro data while risk appetite remains subdued ahead of key releases. European sessions are increasingly acting as a transition zone between Asia and the United States, compressing volatility into overlapping liquidity ranges. This matters because compressed volatility often precedes expansion. Now let's look at the United States. Major equity indexes have pulled back recently. The Dow, the S&P 500, the Nasdaq. Risk-off behavior is resurfacing, particularly in large technology names and equities tied to crypto exposure. Investors are starting to question valuations, not because growth disappeared, but because expectations may have moved too far, too fast. As a result, we're seeing rotation out of the so-called Magnificent Seven and into more defensive positioning. That shift is subtle, but it's important. Turning to the crypto market, digital assets remain highly sensitive to broader financial conditions. Bitcoin has pulled back from recent highs and is trading below key psychological levels. Major altcoins have experienced deeper drawdowns. This weakness is not isolated. Historically, when traditional risk assets weaken, crypto tends to amplify that behavior, not because of fundamentals, but because of liquidity and positioning. And this brings us to the key point. What matters most right now is interconnected risk: equity volatility, trade policy pressure, digital asset drawdowns. These are not separate stories. They are linked through global liquidity dynamics and investor positioning. When one market moves, others respond, not independently, but as part of a single global risk system. From Asia to Europe to the Americas, risk pricing is being adjusted, not because fundamentals suddenly collapsed, but because uncertainty is rising and margins for error are shrinking. In environments like this, markets reward discipline, not speculation. They reward context, not headlines. That's the current reality across global equity and crypto markets.